Thank you, everyone. Appreciate you being here today. I'm going to give you a quick background on me for those who don't know me. I've been discovered the stock market at 10 years old. Was been passionate about it ever since. Bought my first stock at 16 years old, and I've been an institutional money manager for about the last 25 years. 8 years ago, I was blessed with twin daughters, but I already had 3 girls before that. So I had 5 girls under 8 years old looking me in the eyes. That forced me to do a major rethink of my life. I quit my job as a partner in an investment management firm in Montreal. I went home to take care of the family. And I was very, very bullish on gold starting in 2015. And I was sitting at home saying, I think gold's going to go up a lot. That was $1,350 in 2018. Where do you make the most money when gold goes up a lot? Usually, it's the junior miners, the micro-cap stocks, which I had not invested in for my institutional clients because it's a bit too risky for their risk profile. So I started buying juniors. And when I asked myself, how am I going to make money in an institutional, structured way in the junior mining market? I want to adopt a venture capital model. So those of you know the venture capital markets business, in technology, the venture capital model is very well adopted. So Amazon, Facebook, Google, Netflix, they all started off as $20 million market cap companies, received seed funding or venture capital funding. These are big firms in Silicon Valley and California that will invest money in small tech companies, knowing full well that 9 out of 10 investments they make are going to go to zero. But if you get one Amazon, one Facebook, or one Google, you make thousands of % on your money and you have a very good return in your portfolio. So I said, why don't I do that in junior mining? Because junior mining has the exact same risk distribution, but most investors put all their money in one stock or get sucked in by results or stock charts. They don't think about a structured approach to investing in a sector. So let's give you some quick math here. If you walk around the VRIC halls today and you have $100 in your pocket and you put $10 in 10 stocks that you like the most in this mining hall, say one stock, you're really lucky, it goes up 50 times. So it's a 5,000% return on your portfolio. Another stock goes up 10 times, you make 1,000%, and 8 other stocks go to zero. So my sister's a doctor. If she kills 8 out of 10 patients, she's going to be out of business very, very fast in her profession. I'm not as smart as she is, so I chose a profession where I can have 8 out of my 10 investments be absolute failures and still have a really good return. Because if you follow the math on the screen, that's a 500% return on your investment. Now, the second problem is, if you walk around this hall and you pick 10 mining companies, there's a good chance that all 10 will go to zero over time. Because I'm going to break a bad secret for you, less than 1 out of 100 companies you see in the halls here will actually ever become mines. It's a very hard business to find mines. That's why when you find a mine, they're extremely valuable. So again, being structured in my thought process, I said, how can I improve my success rate than throwing 100 darts at a board at VRIC? How do I find the companies that are going to be producing mines? Because the winners, the ones you do find, will go up 1,000, 5,000% or more. And so what I did is I made myself a mining checklist because I've been investing in producing assets for over 25 years. So I said, what are the things that made these producing mines? What are the hallmarks of these producing mines? They only gave me 20 minutes today, so I have to really shorten my presentation. So I made 2 buckets. One, things you cannot change. That's Mother Nature, that's geology. You cannot change the deposit that's under your feet. So your grade, your metallurgy, your scale. You also can't change where Mother Nature put the mine. So you can't change the infrastructure. What are there roads? Is there power? Is there a town? Is there water? And you also can't change where in the world it is. So those are 5 things that I'm very passionate about, but I'm going to skip over them because there's a lot of smart geologists in the room. But essentially, grade is your margin. Grade and metallurgy is your margin. Scale is how much tons or gold ounces you have, so how much volume of rock you can produce and produce cash flow. And then infrastructure, the more you have, the better. If you already have all those things, you don't have to build it. It's going to save you a lot of money. And then finally, jurisdiction, do your own work. What areas you feel safe to invest your money. I like areas where there's rule of law and certainty of ownership in my assets. There's another bucket of things that I look for that you can change or that you can hopefully change over time. First one is management, extremely important. Insider ownership, how much of the management team and board own of the stock. Capital efficiency, their share table, who owns the stock, who's invested in the company. And then finally, changes every single day in the market, valuation. So those are the things I'm going to focus on today in more detail for you. So management, I've probably done, 10,000 one-on-one management meetings in 25 years in my job. I've never sat through a management meeting where the manager says, hello, nice to meet you, Michael. We have a terrible management team at our gold mining company. They all say, we have a fantastic management team, we have a fantastic board, we're all incredible. So if all 10,000 people I've met are all incredible, how do I decide who's more incredible than less incredible in that list? And so I have 3 criteria that I use. First one is economic geologist. So I love stocks. I founded my first passion for the market at 10 years old. I love investing in the market. If you give me $100 to invest, I want to invest $150. I'm an addict. I want to invest in stocks all the time. Geologists love rocks a lot. They love to drill. They love to look at rocks. They love to learn about rocks. They like to learn about geology. So if you give a geologist $3 million, he or she's going to want to spend $5 million. And so my favorite geologists are the ones where I give them $3 million. They have a theory that they're going to drill this target, structural control, there's going to be gold or copper there. They spend $300,000 and say, you know what? It's not looking like I thought it was going to look. As much as I love pulling rocks out of the ground, I should stop spending the money. Give it back to Michael, and let's have a conversation about where's the next place to go. So the geologists that have good geological understanding and also understanding of business, and the money they have in their pocket is not theirs, it's the shareholders, and you got to protect that at all costs. Secondly, you need a strong knowledge of capital markets. Again, I'm not picking on geologists because I love geologists, and you do not want Michael Gentile picking your drill holes for your next drill program. That will not be a successful exercise. At the same time, most junior mining companies are run by geologists, and many of them do not have a lot of experience when it comes to building businesses, raising money, strategy, marketing, finance. And so the ideal junior mining company has really good geologists who, again, understand business, but also a very good business partner or financial mind that helps them raise money and really grow the business to become very valuable. The saddest thing I see in junior mining is when a company makes a really strong economic discovery, but the shareholders don't do well due to bad financing decisions or bad structuring decisions of that company. So it's hard enough to make a discovery in this business. When you make it, you really want to make sure that you have the stars aligned to have the shareholders have a fantastic outcome as well. And finally, you need a strong, engaged board. So why do I say that? The average junior mining company has maybe 2 or 3 full-time employees on the payroll. These are very small operations, but they're going to have maybe 5 to 7 full-time board members. So the average board is 2 to 3 times larger than the amount of full-time employees in the company. Board members do a vital role of oversight and governance. They typically meet once every 3 months for 3-4 hours. But how do you get those board members to give you more than 4 hours a month? How do you get them to be involved in the business day to day and roll up their sleeves and add value without paying them? Is insider ownership. So that, to me, I gave a whole slide for that. Very, very important to emphasize that enough. When you have a management team and board that owns 15, 20, 25, 30% of the company, if we're in a bear market like we've been for the last 8 years until recently, and it gets very tough, they're going to fight really hard to make sure you don't get diluted. If there's an issue in the country, an issue with the asset, they're going to fight really hard to save the value of the company, to preserve it for shareholders. If you don't have a lot of insider ownership, you're counting on the goodwill of management team to stick it out, which I'm a realist. Human nature dictates where your wallet is, where your heart is, your money will be following. People will be much more engaged if they own stock. So look for companies where management and board owns a lot of stock. No matter how fantastic their names are, their background are, if they're not invested in the company, they're less likely to be as involved as they should be. Capital efficiency. So Rick Rule talks a lot about this, and I really agree full-heartedly with him. He talks about liking to invest in companies where you spend a small amount of money and you get a yes or no answer very quickly as to whether the deposit is economic or going to make money for shareholders. I prefer to fail quickly with a small amount of money than to fail over a long period of time with a lot of money. So when you're giving a company money to invest in a project, you're financing them, I always ask them, what are you going to take this money, what are you going to use it for, and what am I going to learn with this investment? And is it going to significantly advance the value of the project, yes or no? Another thing to look at as well is drill costs. If you're drilling in Quebec or drilling in Ireland, my drill costs are $150, $200 Canadian per meter. If you're drilling helicopter-supported drilling in the Arctic somewhere, it could be $1,000 to $1,200 a meter. That means for every dollar you put in the ground, I'm going to get 6 or 7 meters in Quebec or Ontario versus a remote location. Doesn't mean those projects aren't good, but they have to find a heck of a lot more ounces per meter to justify the costs of investing in these projects. So I always think about your money going in, what's the return I'm getting, what kind of impact is my investment going to make in the company? Okay, so back to how as a small investor can you quickly assess the quality of the management team and how they're treating shareholders. I call it the cap table or the shareholder register. I've nicknamed it the X-ray machine. So you take an X-ray, you can see inside someone's body, you know what's going on, if they broke an ankle or they got a problem health-wise. So for me, if you show me a cap table of a junior mining company, I can pretty quickly tell you how much respect they have or not for shareholders. And I've got a long laundry list of pet peeves that I look for. I won't go through them all today, but penny paper is one that I'm really not a big fan of. So you don't know how many phone calls I get. Let's say a smart team puts an asset together, they buy some land, they do some targeting, they get the license to drill the property. They put their money in at a penny, but they have no money, and they need $5 million to drill the asset. They say, Michael, I've got a great opportunity for you. I need your money to drill the project. I want you to come in with $5 million to drill this project. So great, what did you guys pay for your stock? Well, I paid 1 penny. What do you want to sell to me for? 50 cents. Like, you've made 50 times your money before you do any work, and you have no money to drill the project. So I don't mind founders earning a small markup on their paper. It's hard work to put a company together. Many in the room have put companies together, but it has to be reasonable. Both have to be partners in this project. Second one, founder rounds to 1,000 founders. So typically a mining company has 3 or 4 founders. Oftentimes I see cap tables where there's 500 founders. It's all their friends and family, their stockbrokers, their grandmother, their cousins, their nieces, nephews. I don't mind founders getting paper, but let's have the people actually building the business have the founder paper, and investors put the rest of the capital in on reasonable terms. Warrants. So many companies, especially in bear markets, are forced to use warrants. They're a necessary proxy. But if you see a company that has 200 million shares outstanding and 200 million warrants, one, that means they've had a very hard time raising money, which is possible. And two, they probably didn't work hard enough to find high quality investors and have a lot of warrant clippers, people that are fast money that will sell the shares and keep the warrants. So if you see big warrants in the cap table, often a red flag. I'm going to skip through a bunch of them, but flow-through financings as well. If companies do flow-through financings with investors that just want the tax break, they don't care what company they own, that creates a permanent overhang on the shares. So again, looking at the cap table, you can see a lot of red flags that may or may not discourage you from investing in that company. So all of you know the Lassonde curve. Pierre Lassonde is one of the most legendary investors in the mining sector of all time. I'm not worthy to tie Pierre Lassonde's shoelaces, but in all humility, I've taken the Lassonde curve and added my name to it, just to illustrate to you how I look at valuation. So when I invest in a junior mining company, I'm looking to make 20 to 50 times my money. So valuation is extremely important to me, and a good way to get valuation is where are we in the cycle. So you probably all know the Lassonde curve, different stages of a mining life and how the stock performs well. The yellow line is a traditional Lassonde curve. The blue line that you see there is when a gold market or a commodity market is very, very depressed, like we've had much of from 2018 till 2025, where the entire valuation of the whole industry gets depressed due to very negative sentiment. And the red line is when we have euphoric valuations, kind of like we had in the lithium sector about 3 years ago, when lithium went up 1,000% and Moose Pasture was selling for $100 million market caps. And so what I like to do is I like to find points in cycles, like gold was for much of the last 7 years, where the sentiment is blue, it's very, very low, and my outlook is quite positive. And that's where I've been on gold for much of the last 8 years. What that does for you is even before you make a discovery, even before you find more ounces or move your project forward, just the blue line going to the yellow line and the yellow line going to the red line, you make a lot of money before you take any geological risk. So buying ounces 6 years ago at $10 an ounce Canadian in the ground, today they're trading at $40 to $50 an ounce in the ground. That's 4 to 5 times my money before I found an additional ounce. I think they should be trading at $150 to $200 an ounce, so there's still way more room to go. But even before you make any discoveries, you've made money. So buying well when the cycle is depressed gives you incredible value. And then as you go across the Lassonde curve, you generate even more value as the project grows its value organically. So those two combinations together is how you can generate exceptional returns in a sector. And in case I get the question later, I think we're somewhere between the blue line and the yellow line right now on the equity valuations. Obviously people are much more positive than they were 2 years ago, but on a valuation basis, we are still very attractive, especially in the junior sub $200 million market cap place, which I play most of my time. I often also get the question, how do you allocate capital? And again, getting a theme here, I'm very systematic in that as well. So when I find a company that I like, that I think has that potential to go 20 to 50 times higher, I'll put 1% of my total book capital in that investment. I'm targeting a 5 to 20% ownership position in that company. So by default, I'm probably in a sub $50 million market cap for my first investment. And if the company does really well, and they continue to do what they say they're going to do, and they execute the plan according to what we laid out in the initial investment, I'm willing to put up to 5% of my book capital. So kind of 4 more investments of 1% each of my book capital in that investment up to 5%. If I'm lucky enough to find stocks that go up 20 to 50 times, well, that's 100%. 5% times 20 is 100, goes 50 times, that's 250% of my whole portfolio that I've generated with one stock. And that's how the winners pay for all those losers I talked to you about at the beginning of the presentation. I often get the question as well, when do you sell? Well, because I own 5 to 20% of the companies I get involved in, I'm not day trading my stocks, I'm not taking a few profits here and there. There's only 4 really buckets that I would do when I sell a stock. The first bucket is an unfortunate one when I make my initial investment and the company is not doing what they said they were going to do. Either the geology doesn't work out, that's fine, it happens, or the management team is spending on the wrong things or not executing the strategy that I had laid out, we laid out together, we made the promise, I will sell. So it's not going my way, but I've only put 1% of my money in, so that stock's probably down. The rest of my portfolio is probably up. So over a couple of years, it's probably 0.2 or 0.3% of my portfolio. It's no longer really meaningful to me. So I can hold it and hope for better days or sell it, but it doesn't really have a meaningful impact on my portfolio anymore. The second one of my favorites, is takeover bids. So when a project does really well and the company does advance through all those stages, in a strong market, you'll have takeover bids. And I've been fortunate to have many takeovers over the last several years. That's a giant source of liquidity that allows me to reinvest in more juniors. Third one is the company does not get taken over, but the market recognizes the value of the project and recognizes it as a very buildable, high-quality project. Maybe gets listed on the TSX main board, has a $500 million, billion market cap, liquidity picks up, then it's a little bit easier to sell a few shares to fund new investments. Or another great scenario is you buy it as a junior and it goes all the way to production. It's rare, it happens, I've had one or two that do that, and again, that becomes a multi-billion dollar market cap company. At that point in time, a liquidity is abundantly available even to large investors like myself. So this slide, for those that know me, I don't have a big ego. This is not to say, look how well my portfolio is done. This slide is to show you mathematically, my dad's a math teacher, so I love numbers, mathematically how the portfolio stacks up. And you can see here, since 2019, I've invested in 40 junior mining companies. So I'm very selective. I don't go and buy 500 companies. I do about 5 or 6 per year. And since 2019, you can see that I've had several companies that have gone up 5,000, 6,000, 2,000%. So some of those rare winners I'm looking for initially. But you also see, I'm not as smart as I look, I've had a lot of companies that have gone down quite a bit. Some have gone down 100%, 70%, 60%. And by the way, this chart is skewed by the fact that the market's been very good. If you look at this chart, 2 years ago, it would probably be half losers, half winners. So this just shows you that those few winners that you have that do extremely well can pay for a lot of mistakes. It stacks up to a very good portfolio return, about 1,750%, versus a TSX Venture of 100%. The other thing this slide shows you is a lot of junior mining investors make the mistake of selling their winners and keeping their losers. So I call it watering your weeds and picking the flowers out of your garden. So if you pick all the flowers out of your garden and you keep watering the weeds, you're going to end up with a portfolio full of weeds. If you're investing in junior mining stocks looking to make 30% and get in and out, you're in the wrong business, because there's so many stocks that are going to hurt you and go down 100% over time. You have to let your winners run. And so this chart shows you without the winners, this portfolio would not look as good. I'm not saying never sell, but when you get invested at the right time, you have a good company, let those winners do the work for your portfolio. This is another chart just to show you thematically where my portfolio is positioned, again on a no-names basis. The y-axis is precious metals on the top and base metals, getting more towards base metals on the bottom. And the x-axis is where we are on the Lassonde curve, from pre-drilling all the way to production. What you can see here is since 2018, I've had a strong preference towards precious metals. So you can see the vast majority, maybe 70% of my portfolio has been in precious metals. I've been growing in my positioning towards copper. So you can see in the middle there's some copper gold assets that I like. And then I have a few special situations in pure base metals and other commodities that I really like the asset. But again, back to my Lassonde curve, I want to be in assets where I think the next 5, 10 years are going to be in an uptrend so that Lassonde curve can migrate higher. Really quickly, just give you some case studies. Again, just for illustrative purposes, 3 stories. K92 Mining is one that I bought way back in 2017. Great asset. Management had some issues. They changed the CEO, who was fantastic, was able to turn the company around. I made initial investment because of him, John Lewins. And when I saw the work he was doing to turn the company around, I made 4 subsequent investments. You can see following my approach. And that company is a rare one that's gone all the way from resource all the way to producing asset. That stock's probably gone up 50 to 60 times in my portfolio since, and I still own it today. Another one, Northern Superior. Again, you can't change the geology, but you can change the management. So Northern Superior had fantastic assets in Ontario and Quebec. Were run by a really great geologist who had an incredible nose for good targets, but the company was really lacking in the business acumen, the fundraising, and the ability to raise money and grow the business. So I made a small investment in 2017. In 2019, I bought 20% of the company, joined the board, became very actively involved in strategy, financing. We've refreshed the board, we refreshed management team. During the downturn, I made 6 or 7 investments. You can see all the green arrows along the way. The company kept on growing in value. The market was not recognizing it. And over the last 12 to 18 months, the market started to recognize the value. And thankfully, we were acquired by IM Gold about 3 months ago. And that's even increased 50% since the takeover offer due to the shares we received. That one's up another 50 times. So just to show you, it is possible to earn these kind of returns in the business. And then finally, North Isle Copper and Gold. Similar story. Sam Lee came in about 2020. Again, very good asset. Sam Lee brought energy, focus, passion to the business. Been so impressed with how he's executed the story. Again, lots of subsequent investments. You can see Sam was growing the value of the business. The market was not responding to that growth. I continued to increase my position. And finally, now the market has recognized North Isle as one of the premier copper gold assets in Canada. It's soon to be built hopefully by a major mining company or Sam himself. Just to finish off, 10 seconds left. If you guys are interested in what I'm doing in the mining space, I have a free newsletter. It doesn't cost anything. You can go to SaturdayMorningMining.com and sign up. It's not investment advice. Don't write me emails saying, what do I buy? What do you like? It's not that. I put my thoughts on the market, the companies I own, any news that comes out, or any videos or media work that I do that week. You'll get that all Saturday morning at 8 o'clock in your inbox. So thank you very much for your time today.